Right now, while you're watching this, 17 countries are settling trade deals without touching a single US dollar. Not because they hate America, not because of some conspiracy, but because for the first time in 80 years, they finally don't have to. And what's happening next will change how much your groceries cost, what your mortgage rate looks like, and whether your retirement account survives the decade. Stay with me, because this is the most important financial shift you've never been told about. Let me ask you something most economists won't. What makes the US dollar powerful? Most people say military. Some say GDP. A few say trust. All of those are factors, but none of them are the factor. The dollar's real superpower was never about being the best currency. It was about being the only currency, the only one that could settle international trade at scale, the only one every central bank had to hold because every commodity on Earth was priced in it. Oil, wheat, copper, semiconductors, all of it dollars. That meant every country on Earth needed to earn dollars just to survive, to buy energy, to import food, to participate in global commerce. And that created something economists call artificial demand. Not demand because the dollar was strong. Demand because there was literally no alternative infrastructure. Think about it like this. Imagine there's only one highway connecting every city in the country. It doesn't matter if the road is cracked, flooded, or falling apart. You have to use it. There's no other route. That was the dollar for 80 years, but here's where everything changes. And this is the part that should concern every single American watching this. New roads are being built, quietly, efficiently, and they're already carrying traffic. Now before I show you exactly what these new roads look like and why they're accelerating faster than any government wants to admit, you need to understand one critical distinction. Because the media keeps getting this wrong, and it's costing people like you and me real money. Every headline you've read about de-dollarization focuses on the wrong metric. They talk about reserve currency percentages. They show pie charts. They say the dollar is still 60% of global reserves, and then they conclude nothing's changed. That's like saying Blockbuster was fine in 2007 because they still had 6,000 stores. The metric that actually matters isn't reserves, it's settlement. Let me explain the difference because this is where the entire game shifts. Reserves are what central banks hold in their vaults. Think of it as savings. Countries keep dollars saved up because they might need them. Settlement is what happens in real time when two countries actually trade. When Saudi Arabia sells oil, when Brazil ships soybeans, when Indonesia exports nickel, the currency those deals are executed in, that's settlement. And here's the earthquake nobody's covering properly. Settlement is where the exits are happening first. China and Russia now settle in yuan and rubles. Done. China and Saudi Arabia have completed yuan-denominated oil trades. Confirmed. India and the UAE are settling in rupees and dirhams. Operational. Brazil and China, yuan settlement. Active. ASEAN nations are building local currency settlement frameworks right now. This year, not someday. Now, each one of these is a crack in the highway, not a pothole, a crack, and cracks spread. Because here's what happens when settlement demand drops. The US Treasury market, the backbone of American borrowing, loses its most reliable foreign buyers. And that's where this story stops being about geopolitics and starts being about your bank account. I'm going to show you exactly how this reaches your wallet in a moment. But first, you need to see the infrastructure that's making all of this possible. Because this is what the mainstream financial media refuses to explain clearly. For decades, global finance ran on a single nervous system. SWIFT, the Society for Worldwide Interbank Financial Telecommunication. Every major cross-border payment, every international wire, every trade settlement between banks flowed through SWIFT. And SWIFT was controlled, effectively, by Western institutions, which meant the US had a kill switch. Sanction a country, cut them off from SWIFT, and they couldn't trade internationally. Period. It was the ultimate financial weapon. Until it wasn't. Because when you weaponize infrastructure, you don't just punish your enemies. You motivate everyone else to build alternatives. And that's exactly what happened. China built CIPS. the cross-border interbank payment system. It now connects over 1,400 financial institutions across more than 100 countries. Russia built SBFS, their own financial messaging system, smaller but operational and growing. India developed UPI for domestic payments and is now extending its architecture internationally. Central bank digital currencies, CBDCs, are being tested by over 130 countries, not as theoretical concepts, as functional settlement tools. And then there's mBridge. This one almost nobody is talking about, and it might be the most important. mBridge is a multi-central bank digital currency platform. It connects the central banks of China, Thailand, the UAE, Saudi Arabia, and Hong Kong in a system that allows instant, direct settlement without ever touching the dollar or SWIFT. Read that again. Instant, direct, no dollar, no SWIFT. It's not a protest, it's not a political statement, it's plumbing, financial infrastructure. And infrastructure is permanent. You can reverse a policy, you can walk back a tariff, you can renegotiate a trade deal. You cannot unbuild a payment system that works. Now here's where this gets personal, because everything I just described sounds technical, sounds distant, sounds like something that happens over there. It's not. It's already here. And the math is about to hit your front door. Let's talk about what the dollar's reserve and settlement status actually gave you, not America in the abstract. You, lower mortgage rates, because foreign governments bought trillions in US treasuries that kept interest rates artificially low. Your 30-year fixed mortgage at 3%. That wasn't just the Fed. That was China and Japan subsidizing your borrowing costs by parking their trade surpluses in American debt. Cheaper imports, because the dollar was overvalued relative to fundamentals. Thanks to that artificial demand, everything you imported was cheaper. Your electronics, your clothes, your car parts, all of it effectively discounted by the dollar's inflated purchasing power, affordable government spending. The US government has been running deficits for decades. It could do that because there was always a buyer for its debt. Foreign central banks had to buy treasuries because they had to hold dollars, because they had to settle trade in dollars. That's the loop, and it's the loop that's breaking. So what happens when foreign buyers slow down? When they don't need as many dollars? When they start settling in yuan, rupees, dirhams, and digital currencies? First, treasury yields rise. When there are fewer buyers, the US government has to offer higher interest rates to attract new ones. That's already happening. Look at the 10-year Treasury yield over the past 18 months. The trend is undeniable. Second, mortgage rates follow. Your mortgage rate is directly tied to Treasury yields. As yields climb, so does your cost of borrowing. That dream home, it just got more expensive, not because of your credit score, because of geopolitics you were never told to watch. Third, the dollar weakens. Less demand means lower value. A lower dollar means imports cost more, your grocery bill goes up, your gas costs more, your Amazon orders get pricier. And here's the cruel part, this can happen even during a recession. It's called stagflation. Prices rise while the economy shrinks. And it's the one scenario the Federal Reserve has no clean answer for. Fourth, government borrowing costs explode. The national debt is now past $34 trillion. Even a small increase in average borrowing costs adds hundreds of billions in annual interest payments. That money has to come from somewhere. Higher taxes, reduced services, or, and this is the path most likely chosen, more money printing, which makes the inflation problem worse, which weakens the dollar further, which accelerates the exit from dollar settlement, which brings us right back to the beginning. That's not a straight line, that's a spiral. And if you think the government has a plan to stop this spiral, I need to show you why every tool they have left actually makes the problem worse. This is the part that keeps economists up at night. The Federal Reserve has essentially two levers: interest rates and the money supply. If inflation rises because the dollar weakens, the Fed should raise rates. But raising rates increases the government's borrowing costs on 34 trillion in debt. It slows the economy. It crushes housing. It triggers unemployment. If the economy slows, the Fed should cut rates and inject liquidity. But doing that weakens the dollar further. It accelerates inflation. It incentivizes even more countries to exit dollar settlement. Raise rates, fiscal crisis. Cut rates, currency crisis. Print money, inflation crisis. Do nothing, confidence crisis. Every door leads to another problem. This is what's called a policy trap, and policy traps don't resolve through clever management. They resolve through structural change, sometimes gradual, sometimes sudden, but always painful for those who didn't prepare. And here's the historical pattern that should send a chill down your spine. Every single time this has happened in history, every time a dominant currency lost its settlement monopoly, the transition was obvious in hindsight, but invisible in real time. The Dutch guilder, the British pound sterling, the Spanish real. People living through those transitions didn't read headlines saying, "Your currency is collapsing." They saw gradually rising prices, slowly tightening credit, a vague sense that things were getting harder without a clear explanation why. Sound familiar? Now here's what's fascinating. While the public debates whether de-dollarization is real, the institutions that manage actual money are already repositioning. Central banks globally bought more gold in 2022 and 2023 than in any period in the last 55 years. Not gold ETFs, physical gold, bars, vaulted in their own countries, away from the reach of any foreign government. That's not a speculative trade. That's a structural hedge against currency system change. China has been reducing its US Treasury holdings consistently while simultaneously increasing gold reserves, building yuan settlement infrastructure, and locking in long-term commodity deals priced in non-dollar currencies. Saudi Arabia, America's most critical petrodollar partner for 50 years, is now openly accepting yuan for oil sales, joining Chinese-led financial institutions and diversifying sovereign wealth into non-dollar assets. The BRICS bloc, which now includes Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran alongside the original members, represents over 40% of global GDP by purchasing power parity, and they are actively building parallel financial infrastructure. These aren't random moves. This is coordinated migration. And when institutions migrate, retail investors are always the last to know. Always. Not because the information is hidden, but because it arrives disguised as something else. It arrives as inflation, as higher rates, as economic slowdown, as market volatility. By the time the average person connects the dots, the smart money has already moved. So let me be clear about what I'm not saying. I'm not saying the dollar collapses tomorrow. I'm not saying the dollar loses reserve status next year. I'm not saying you should panic. What I am saying is this. The structural foundation that gave the dollar its dominance is being actively and systematically replaced. Not by one country, by dozens. Not through declarations, through infrastructure, not overnight, but faster than any previous currency transition in history, because technology compresses timelines. The British pound took roughly 70 years to lose its dominant settlement role, from the early 1900s to the mid-1970s. That happened in a world of telegraphs, paper ledgers, and slow communication. This transition is happening in a world of instant settlement, digital currencies, AI-driven capital allocation, and real-time information flow. The compression is real, and it means the window between early awareness and too late is smaller than it's ever been. Right now, we are in that window. The question is not whether the shift is happening. The question is whether you'll recognize it before the consequences arrive at your doorstep. Here's what I want you to do right now. First, understand that this isn't about fear. It's about awareness. The people who navigate transitions successfully aren't the ones who predict exact dates. They're the ones who recognize patterns early enough to position instead of react. Second, start watching what institutions do, not what politicians say. Track central bank gold purchases. Watch treasury auction results. Follow settlement system adoption. The data is public. The interpretation is where the edge is. Third, diversify your exposure. Not just your portfolio, your assumptions. If your entire financial life is built on the assumption that the dollar will always be the world's settlement currency, you are making a bet. And it's a bet with declining odds. Now I need your help with something. If this breakdown made something click, if you saw a pattern you hadn't connected before, hit subscribe right now. Not for me, for you. Because this channel is going to continue tracking this shift in real time. Every week. With data. With context. Without hype. The next video is going to break down exactly which assets have historically survived currency transitions and which ones got destroyed. You do not want to miss that one. Drop a comment right now telling me what's the first thing you're going to look at differently after watching this. I read every single comment, and the best ones shape future episodes. Share this video with one person who needs to hear this. One person who's still assuming everything stays the same. Because the biggest risk isn't being wrong. It's being unaware. I'll see you in the next one. The dollar isn't dying. It's being made optional. And optional is worse.